Let's bring in George Jarkesy, CEO of Jarkesy and Company, and of course still with us, Gemma Godfrey of Credo Capital. I'll start with you, George. I mean, how do you feel about the sort of the macro marketplace right now? We have China slowing down just a little bit, but it's still 9% growth. We have France. We just talked about a possible downgrade there, and we don't know what's going to happen with the banking crisis. And earnings have been pretty meek here in the U.S.
Well, the macroeconomic picture is factoring in the volatility, and the question is it factoring in enough? You've got Germany on a defensive posture. You've got various countries being downgraded. You've got questionable growth and new risks in America. You have a slowing China, and so I think the market volatility over the last month is factoring in those risks.
Right.
And we're going to continue to see that until people feel like there's a direction and that some of that risk is we're passing that risk.
Well, I mean, I want to get into what's going on in the U.S. economy, and you have keen insight into actually the small business dynamic. But having said what you just said, does that make you inclined to look to be active in the marketplace, or are you just sitting by and saying, listen, I'm going to let this stuff take care of itself, and then I'll make a move?
Well, every portfolio has to make its own decision, but from historicals, I mean, there are good values out there. There's some great values in emerging growth in energy. There's a lot of value there. The overlying fact, though, is you know, from not just today but over the next year or two, is from an American standpoint, is how do we deal with our debt? How do we deal with our excessive government spending? And then how does that affect our currency? Are we going to have an inflationary environment? Are we not going to have an inflationary environment? And so I think it's sort of where you fall in that range of what you're thinking. And our perspective is we have to have some inflation with our current debt as a country to work our way out of where we're at. And so at some point, sometime, we're going to see inflation, and then you have to prepare your portfolio for that inflation.
All right, Gemma?
I mean, it's obviously quite interesting that in viewing the earnings season, there's been this huge disparity between how stocks have performed, which actually it's more to do with expectations and where the price has moved over the last 12 months and actually what the result is. I mean, would you agree with this point, and is that how you're guiding how you're trading your portfolio at the moment?
Well, I think expectations that we typically have had, you can't hold those at this time. You've got a consumer that is I would say, you know, questionable or sideways. But more importantly, you have a market in the U.S. where you have stock renters. You don't have investors in the market. A little bit of changes in the stock liquidates right away, and they're out of it. They're not holding for a position.
You know, I had this debate with Ross off camera. It just seems that it's a sign. If we trade down 200 on Germany chatter or what have you, I know it's oversimplification. The market seems to be broken. That it's just a trade. All momentum trades right now. It's not. The argument I had, and I talked with Keith McCullough on Twitter, is that it doesn't seem like there's a lot of fundamentals driving things, even though there are a lot of fundamentals being streamed into our consciousness, like earnings and other data points. It doesn't seem like we're trading on anything but fear and commentary.
Fundamentals have been thrown out of the window, and I don't care whether you're talking about Washington and how they're looking at it, how Wall Street's looking at it, how analysts are looking at it, how the banks are looking at it. Banks aren't doing normal lending when it comes to loan-to-asset value, loan-to-cash flows value. Wall Street, the normal PE ratios and other things that are done. If a lot of companies, a lot of stocks are cheap compared to that, and so you see these people coming in short term, and I guess because of the experience in 2008. The slightest bit of negativity or even hint of negativity, and they're out. And that's why these fluctuations are so wild over the last 2-3 months.
Somebody's making money, but it's not usually the retailer. Gemma, you got another question?
Well, actually, it's more of a supporting fact that if we look at how investors are actually investing in the markets at the moment, they're gaining access via ETFs. So we've seen 2.3 billion of inflows via ETFs, whilst outflows are continuing via funds. And the reason, obviously, is that they're exchange traded. And exactly as you said, it's people that are coming into the markets that are buying exposure, but in a way that they can actually get out very quickly. And that's not long-term bullishness.
What are the pension funds guys doing here? Pension funds are supposed to be investing our money for the long term. And they're looking at bond yields, which clearly offer nothing, right? And they've got to get a return on their assets. I mean, what are these guys doing?
Well, if you look at the trend, it's a very interesting trend. Exactly that. Everyone's trying to grapple on yield. Where do we get yield from? How are we going to actually achieve targets? Because obviously, if you look at pension funds, they're very much target-driven. And the way they're doing that is they're reducing exposure to developed market equities, developed market bonds, because they're very long-term holders. And instead, they're actually looking at alternatives. They're looking at hedge funds. They're looking at alternative ways to gain exposure into assets that can deliver in a potentially tough environment.
Listen, the pension funds have bigger problems than just the yield. The problem with the pension funds is as our healthcare has gotten better globally, what have you, and especially here in America, you're going to see longer life expectancies. And so you're going to find that these pension funds for the long term are underfunded, unprepared, and with the yield are really going to be in trouble.
All right. Well, listen, we got to leave it there for now. We're going to get more comments of both of you. And George, I want to, you say you're a long-term investor, so how do you deal with the environment we just discussed? And we'll get to that in just a few minutes. George Jarkesy, CEO of Jarkesy & Company.